EUR/USD struggled to capitalize on its modest uptick and remained below the 1.1300 mark. The risk-on mood undermined the safe haven USD and extended some support to the major. Hawkish Fed expectations acted as a tailwind for the USD and capped the upside for the pair. The EUR/USD pair edged higher on Tuesday, though the uptick lacked bullish conviction or a strong follow-through buying. A supportive factor for the pair was the prevalent risk-on mood that dented demand for the safe haven US dollar. The shared currency, meanwhile, was underpinned by better-than-expected German industrial production data, which recorded strong growth and jumped 2.8% MOM in October. A growing acceptance that the Fed will tighten its monetary policy sooner rather than later to contain stubbornly high inflation continued acting as a tailwind for the greenback. Markets have been pricing in the possibility of an eventual liftoff by May 2022. This, along with a further recovery in the U.S. Treasury bond yields, limited downside for the USD and kept a lid on any meaningful move up for the major. The European Central Bank has been pushing back on market bets for tighter policy and talking down the need for any action to counter inflation. The divergence in monetary policy stance between the ECB and the Fed further held back traders from placing any aggressive bullish bets around the pair. The fundamental backdrop seems tilted firmly in favor of bearish traders and suggests that the path of least resistance is to the downside. Next on tap will be the release of the German and Eurozone ZEW Economic Sentiment Index, which might influence the common currency and provide some impetus to the major. There isn't any major market-moving economic data due for release from the US, leaving the USD at the mercy of the US bond yields. Apart from this, broader market risk sentiment will drive demand for the safe haven USD and produce some trading opportunities around the major. Technical outlook. From a technical perspective, nothing seems to have changed for the pair, and acceptance below the 23.6% Fibonacci level of the January 1692 to January 1186 downfall supports prospects for additional losses. Some follow-through selling below Friday's swing low, around the 1.1265 area, will reaffirm the negative bias and turn the pair vulnerable to retest sub-1.1200 levels or the YTD low set on November 25. This is closely followed by the 1.1170 to 65 resistance breakpoint, turn support, below which the pair could slide to the 1.1145 support area. The downward trajectory could further get extended and drag the pair towards the 1.1100 round figure mark in the near term. On the flip side, any attempted recovery back above the 1.1300 mark now seems to confront stiff resistance near the post-NFP high, around the 1.1330 to 35 region. A sustained move beyond has the potential to lift the pair back towards the 1.1380 to 85 resistance zone, 38.2% Fibo level, en route to the 1.1400 mark. Some follow-through buying might prompt a short covering move and accelerate the momentum towards the 50% Fibo level, around the 1.1440 area.